अरे मौका बिना फिक्र के जीने का मिल गया। 12 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया। जो आने वाले कल की प्लानिंग करके चलते हैं, सोच समझ कर उनको इन्वेस्ट करने का सलीका मिल गया। 12 20 और 80 से पीस ऑफ माइंड मिल गया। म्यूचुअल फंड में इन्वेस्टमेंट करने का तरीका मिल गया।
Finally balanced, active, passive, index or managed, सभी का मिल गया।
क्वांटम के म्यूचुअल फंड, क्वांटम के 12 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया।
क्वांटम म्यूचुअल फंड के 12 20 80 यानी 12 20 80 एसेट एलोकेशन अप्रोच ने इंडिया को सिखाया इन्वेस्ट करने का सही तरीका। और जानकारी के लिए सर्च करो क्वांटम 12 20 80 एसेट एलोकेशन। म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना संबंधी सभी दस्तावेजों को सावधानी से पढ़ें।
Good evening, everyone, and a warm welcome for the webinar. My name is Neeraj Kotian, and I'll be the moderator for today's session. I'm part of customer interaction team at Quantum Mutual Fund. Thank you all for taking out time on Friday evening and joining us for the session. We'll request everyone to use the headphones for better audio clarity. In today's webinar, the presentation will be for approximately 45 minutes, and then it will be followed by Q&A. You all can post your questions in the chat box once the presentation is over. So India is expected to grow at 6.5% of GDP and shows a positive outcome that includes job creation, productivity, and increase in total output. Although the threat of El Nino looms around, along with geopolitical tensions, weaker external demand headwinds, and global market uncertainty are some of the macroeconomic factors that cannot be denied. Hence, in today's session, let's find out how equity investment may offer capital appreciation, risk diversification, and aid in a stronger investment portfolio. Today, our speaker will answer questions like, what are the key equity investing strategies surrounding the rising market? How will macroeconomic key indicators affect Indian economy? Why timing the market is essential for investors? So before I hand over the control to our speaker, let me quickly introduce them to you all. Our first speaker for today's evening is our Chief Investment Officer, Mr. Chirag Mehta, who has close to 2 decades of experience in managing commodities and specialized in the field of alternative investment strategies. He has been the fund manager for Quantum Gold Savings Fund, Quantum Equity Fund of Funds, Quantum Multi-Asset Fund of Funds, and Quantum India ESG Equity Fund. And our second speaker for today's evening is Mr. George Thomas, who has close to 7 years of experience in equity research across multiple sectors. He has been part of Quantum since 2016, and at present is the fund manager for Quantum Long-Term Equity Value Fund and Quantum Tax Saving Fund. So without taking much time of yours, we'll request our speaker to take her into the session. Over to you.
Thank you, Neeraj, and thank you everyone for joining us today. Today's topic is navigating the market rally, strategies for equity investing. So let's look at the market rally that we are seeing, markets at all-time highs. I'm sure there will be much concerns on investors' mind whether this rally that we are seeing is based on strong growth, which is leading to earnings growth for companies, and therefore, is it a robust and sustainable rally, or is it just again, a euphoria building in the markets? So we'll try and address those issues for you today and tell you what are the best strategies to play this kind of market that we're seeing overall. So if you look at, we always say that, equity should be crux of your asset allocation, but at the same time, don't take your eyes from other allocations, which kind of help your portfolio during times of stress. So of course, there should be a wealth generating asset class, which is 80% debt equity, but that you begin only after building your emergency corpus and at the same time diversifying into assets like gold. So you complete your asset allocation that way, but crux of the allocation, because you need to, at the end of the day, generate wealth over the long run, which helps you meet your financial goals, helps you tide over inflation, and therefore you need a component which can beat inflation and help you raise your standard of living. So your 80% of your allocation should be into equities overall. And there is a simple calculator on a website which helps you asset allocate by filling in just very small details of yours, like your planned investment, your monthly expenses, and therefore telling you what should be your emergency corpus, what should be your equity allocation, and what should be your gold allocation overall. So it's very, very simple. Please try it on our website. Let's address the elephant in the room. Whether there is growth in the economy, whether there is likely to be persistent growth, which will aid revenues of companies and which will lead to earnings growth for those companies, which will mean that the recovery that we are seeing or rally in markets that we are seeing is going to be based on certain earnings growth pillar, but at the end of the day, markets which will reflect fundamentals, and fundamentals, are they robust enough or not? So let's look at growth. So post-COVID, so even before COVID, you see the blue line on the left-hand side chart, which is the nominal GDP growth, which is telling you that there was some decline from the trend GDP growth that we were seeing. And that was because of certain shocks that we saw in the economy. The demonetization, the GST, which kind of took time for markets and economy to adjust. And therefore, our growth kind of slipped below the trend line that we are seeing. And then because of COVID, it even fell further. So overall, we were trending lower than what should be our trajectory for GDP growth would have been. But if you see now, we have caught up in terms of the cyclical recovery that we're seeing in the economy is leading to higher growth rates. Of course, inflation was higher, which is yielding the nominal GDP line over and above the trend GDP growth. At the same time, if you see the real GDP growth at the right-hand side chart, it's still much lower than what our trend GDP growth would have been. So if you look at the original trend GDP growth, it's 9% below that. And if you kind of price in the risk that we saw because of demonetization and GST, it's still below the trend GDP growth, despite those shocks that we would have witnessed, which was it's about 3% lower than that growth trend that we would have witnessed otherwise. So from a real GDP growth perspective, we still have not recovered to the growth trends that we should have seen as an economy because of COVID. I think we are catching up. So from a growth perspective, I don't see there is, euphoria. We are still below the trend GDP growth rate, and we should kind of continue to recover at least towards the trend GDP growth line, because markets and economy have adjusted to the new normal. And now we should be going closer to the line at the top on the right-hand side chart, which should fuel in more real GDP growth in the economy. So we expect the cyclical recovery to continue in markets. What's leading to this recovery in markets? Is this based on certain factors that we see unfold? So one is we've seen there is stronger corporate balance sheet. If you see leverage on the corporate books is much lower. We have a sound financial system which is ready to lend to growth wherever it occurs. And we have an improving demand outlook because post-COVID, the employment sector is also shaping up well. And we'll see that post the revenge spending that we saw in the economy, the recovery in other sectors which was lagging is now starting to show up. So if you look at the capital expenditure by center, by states as a percentage of GDP, it's closer to 5.8% of capital expenditure, which is leading to enough stimulus in the economy to ensure that there is kickstarting the private capex. There is recovery on demand because of employment taking place because of this capex. And as demand recovers, we will see that the cyclical recovery or the consumption ability of the economy, which is the cornerstone of the Indian economy, is going to persist going forward. So overall, if you see the government capex on the left-hand side chart is leading to more private capex because there is employment, there is incomes increasing, which is leading to more consumption. And as capacity utilization increases, the private sector comes in and installs more capacity, which is again leading to fresher investments, fresher employment, and therefore again leading to cyclical or a vicious circle moving on in the economy of capital expenditure and leading to consumption. So overall, we think that we are good from a demand perspective, given we have capital expenditure, which is stimulating overall growth. Also, if you see the capex revival or that we are witnessing today in the economy should help profitability in banks as well. So if you look at banking system, which was going through times of stress between periods of 2015, 2020, is now in a much better shape. If you look at on any metric, like if you see credit growth, which was around 8-9%, is now again inching back to what levels we had seen earlier, upwards of 15% credit growth. If you look at 2023, because this is only till 2022, 2023 data suggests that it's even improved further. So overall, the phases that we saw from 2015 to 2020, 2022 were not marked by good growth. It was a cycle of cleansing within the banking system. Now we are seeing that their margins are increasing, the return on assets increasing, the NPA levels are declining. So overall, the banking system is ready to support the credit growth that we may witness over the next couple of years. Also, if you see, there is higher infrastructure spending. So if you look at ports, capacity handled at ports, that also has been going up significantly. If you see turnaround time at ports, that has declined because capacity has increased overall. So there is a lot of infra spending also happening, which is leading to improving efficiency and therefore a much better economic tailwind that it kind of supports. Also, if you see the rail network or the road network has been increasing over last many years, which is leading to better movement of goods and services. Also, the building of roads and railways itself has a multiplier effect on the economic activity because of all the spending and employment that it takes place, and it further helps movement of goods and services, which is kind of aiding the recovery to an extent. Also, apart from the growth levers that we are seeing from capex spending, what we are also seeing is moderation in inflation. So inflation, which was a worry for not only India, but global markets, is been trending lower. So if you look at the CPI has come very close to 4% mark. If you see WPI inflation, wholesale price inflation is in negative territory now on a year-on-year basis. So overall, this is leading to saying that, you know, the inflationary pressures that consumers faced is slowly inching down. The inflation pressures, the cost input inflation that corporates saw, which depressed their profitability, is being now lower. So this will help consumption increase at one end. At the same time, it will help in increasing profitability for corporates, given those input cost pressures and out of way, and will lead to better profitability for the corporate India. Also, if you see the corporate sector is kind of benefiting. If you look at the growth in earnings or net sales or even profitability of companies in India, then speaking about the non-financial sector, is being very, very robust. So if you see net sales were kind of flattish over last 1 year. But if you see the profitability, as inflation starts moving down, the profitability has been inching higher. So even if you see the margins that companies are reporting is kind of in an upswing now, given inflation pressures are receding and they are maintaining the level of sales or revenues. We further expect as economic recovery continues, the sales or revenues of companies will also start inching up, further aiding the profitability that we saw. So current profitability move is coming from receding of inflation, and the next leg would come from increasing sales as well. Also, if you see from a valuation standpoint, though many say that Indian markets are expensive, if you look at the last 10 years, we were trading at 23 times PE, price earnings ratio. Current PE is also at the same level at 23 times price earning ratio. if you look at in contrast with other emerging nations or developed nations, we look expensive as compared to them. But if you look at the earnings growth, we have a very steady earnings growth profile that is supporting that higher valuation. So higher valuation in line with historical valuation. But if you put it in terms of contrast with other nations, we are trading expensive, and it's for a reason. It's not that we have become expensive; they have become cheaper to some extent. And the earnings growth profile of India supports that higher valuation because it's more steadier market from an earnings growth standpoint. So if you look at in comparison, 2023 estimates or 2024 estimates, earnings growth in the economy is kind of in double digits and increasing, which is not true for many other countries out there. So many other indices, either they have, lower earning growth or deteriorating earnings growth, or, negative in 1 year or positive in the next year kind of thing. India is one market which offers much stability and steady earnings growth profile. Also, if you see, last year, we saw a big exodus from foreign investors leaving India. There was a lot of outflows, and that was more a tactical shift rather than structural shift, because India was trading as we've seen in the previous slide, continues to trade at a higher valuation as compared to many of these economies that you see on the slide, be it Indonesia, Philippines, Taiwan, Thailand, Vietnam. So it continues to trade higher, but now again, looking at a place where they can get a certainty of earnings and economic growth is India. And therefore, you see that what we saw as $17 billion of outflows, which was highest after Taiwan, which saw 44 billion outflows for certain other reasons. India was the second largest outflow from all these nations overall. But this year, if you see, we have started looking at inflows. Even this month, we will see inflows from foreign investors. So overall, what they were shying as an expensive market, they are returning back, saying that this is a market which offers us a steady growth profile. So overall, if you see, we continue that they will continue to flow in positive territory in Indian markets because of improving profitability, and at the end of the day, markets should reflect fundamentals. So fundamentals are very strong for Indian markets. If you look at corporate debt to equity ratios have gone down. It's lowest what we have seen in last 30 years. Corporate return on assets, which were low significantly, have started to improve and are at much decent levels now. This should fuel in this return profile should fuel in further capex from the private sector if we continue to see recovery. So overall, improving profitability and higher return on assets should encourage private investment further, because they have room. They have deleveraged all the while, and now as they see demand increasing, they have the capacity to take on more leverage and build more capacity. Overall, if you see, even in the banking sector, we have seen improved asset quality. The NPA ratios, if you see, have been trending much lower, although from in the previous cycle, we saw it trend even further lower. So I think given the improving profile that we are seeing, there's not much pressure from a non-performing asset perspective, and we should see it further go down from these levels. Also, if you see, the banking sector is very well capitalized this time around. So if you see over last 10 years or so, the capital adequacy ratio is much higher than what it used to be. We used to be around 11-12%. We are around more than 14% in capital adequacy. So that should also fuel the bank's ability to lend further to the corporate sector as they kind of try and grow further. So overall, I think financial system has much more strength now to support the growth that we may see. So with that, I think I will hand it over to George to tell you about, what apart from banking sector that we discussed currently, given the improving profile of banks, what other sectors look promising from here on, and how you can play those sectors.
Thanks, Chirag. So I'll just talk about the consumer discretionary space, where we have an outsized position in the two-wheeler market, and how that sector is playing out in the current environment. So if you look at the rhetoric which has been happening in the last few years, the general perception has been the electric vehicles or the EVs would probably take a giant leap, and when the newer EV OEMs might come up in the picture, you might see some stress on the traditional players. But what we have seen in the recent times was, most of those EV startups and smaller companies were reliant on government subsidies, which has to be curtailed if EV adoption goes to a larger scale. And therefore, the more likely outcome is ICE or the traditional internal combustion engines would continue for a foreseeable future with a marginal contribution from EVs, at least for the next few years. And that has clearly played out post rationalization of the subsidy for the electric two-wheelers, which was announced a couple of months back and which is effective from the current month. So that could give some uptick to the traditional OEMs who are operating in the two-wheeler space. The other major factor was the two-wheeler segment saw rapid price hikes, primarily because the input costs have gone up, be it commodities or even thereof, because of regulatory norms. The vehicles had to have more features, which costed more, and that translated into higher price hikes. And even that higher prices have kind of absorbed, pretty well absorbed in this market. Therefore, as the affordability has improved, plus you're seeing lower threat from those EV incumbents, we could see a quicker revival in terms of the volumes for these two-wheeler players. And if you look at the volume growth, how it has panned out over the last many block of years, post 2019, we have been in a steady decline, like you can see in the graph on the right-hand side. And post from the last year, we are seeing some bit of uptick. Our sense is as the economy gains pace and as the mass segment does better with inflation moderating, we could see a better uptick in the two-wheeler space. So even in that table, if you look at it, even within different segments of auto, two-wheelers has been under-indexed or has been growing at a much lower pace compared to what it actually requires. And therefore, even the replacement cycle would pick up at some point in time. Next slide, please. So the other sector where we have a non-consensus view is the IT sector, where valuations have corrected significantly, and the sector is looking fairly attractive at this point in time. So before getting into the current environment, I'll just give a perspective on how we have approached the sector. So most of our positions were built up or were increased in the IT sector during the 2015 to 17 period, when all these digital technologies kind of gained pace, and there were widespread apprehensions whether the existing workforce can be retrained for those digital skills and things. So at that point in time, IT sector was trading pretty cheap, and as you can see even in that valuation chart on the left-hand side, between 2015 and 19, when the sector became really cheap. And that's when we built up most of our IT positions. IT sector weight moved from single digits to about 16-17% kind of levels. And post-COVID, there was a rapid increase in IT spends, and that reflected in expensive valuations. We trimmed our positions to some extent, but we still had a fairly decent weight in the last, even over the last couple of years. And the reason why we have maintained a reasonably high weight was a couple of things. One, the current environment looks significantly different than how the past slowdown periods look. Even when we look at the principal geography where the IT sector demand comes from, which is the US, the economic indicators are fairly strong, irrespective of there has been sporadic news of some bit of banking crisis and things, but the scale is nowhere comparable to what we have seen in the past down cycles. So our sense is, the current softness in demand is more transient, and as and when it kind of picks up, we would see a reasonable demand coming up for these IT sector companies. And even when you look at the sector valuations, or even when you look at the free cash flow yields, which kind of gives you an indication, how the valuations pan out with respect to broader market, IT sector continues to be at a discount to the broader Nifty or the broader markets, which means, there is reasonable value even compared to the broader markets. And another important factor which I would like to highlight is a period between 2008 and 9, when the uncertainty kind of intensified to a large extent. And what we typically see in among the Indian IT service players is, when there is a lot of uncertainty, enterprises try to optimize their cost. They would pick up all these cost optimization deals. Plus, there could be vendor consolidation, and they might outsource more to offshore locations where engineering talent is available at a cheaper rate. And even if that kind of an environment pans out, which does not feel like the base case at this point, we could see a fairly rapid growth in those IT service demand, like what is reflected in the performance in 2009. And so if you look at this overall period of almost close to 2 decades, so what we see is, when the sector goes through a downturn, it comes back and with stronger growth in 2-3 years, primarily because if you defer those technology spends, your business kind of suffers, and it's more of an essential kind of nature, which requires, enterprises to prop back their IT spends at some point in time. So coming to our recommendations in terms of how investors should position in the current environment, I would just give a background of how the economic environment transpired over the last few years with the help of this chart. So this chart, it represents the earnings estimates of Sensex, which means if we assume Sensex as one lot, this would be the EPS of that Sensex index. So this starts from every, as analysts, all the sell side analysts kind of estimates what could be the Sensex earnings next year or 2 years down the line. And what transpired between 2015 to 2020 was, if the analyst had forecasted, let's say, the Sensex EPX could be 100 2 years later, the actual panned out number used to be, let's say, 80 or 70, which means, the economy was constantly underperforming analyst expectation. And even the growth rates across the sector was kind of weak. And even when we used to meet company managements or channel partners, we used to come back with a fairly negative feedback, or the feedback used to be very different from what we used to see in the stock prices. So as a result, when earnings do not transpire as expected, and stock prices just move up in a one-way rally, what you would see is very elevated price to earnings multiple or valuation ratios. So in that kind of an environment, an investor who is focused on fundamentals, who invest based on the risk reward metrics and valuation, who gives importance to valuation metrics, would essentially be left with a very less number of opportunities, because from a broader economic perspective or market perspective, there are very few companies where the earnings growth or fundamentals justify the kind of valuations where they trade at. And out of those very handful of companies which has a reasonable growth, probably marginally better than the broader markets, the PE ratios used to be substantially higher, which is unjustifiable for a fundamental investor or an investor who is sensitive to valuation. So that has been the case until FY20 and FY21. We had COVID, and that saw some bit of disruption in earnings. So post FY21, if you look at from years from FY22 and 23, so whatever the earnings and analysts used to focus, the actual number used to surpass his estimates, which means there was real economic momentum on the ground. And the price appreciation was also substantiated with an equivalent earnings recovery. It was not just the valuation expansion valuation multiples. It was also accompanied with an improvement in earnings, which is a fairly healthy environment. And we see that environment continuing in the medium term. And that makes us fairly constructive on the markets. So when we look at the portfolio construction process, so for every stock we buy into the portfolio, that stock has a predefined buy limit based on 2-year forward numbers, and then there is a sell price or what is typically called the target price. So from that buy price, if you calculate the percentage return you are likely to achieve that target price, that's called the upside potential. And if I aggregate the upside potentials of all the stocks in the portfolio with respect to its respective weights, what we would derive something called as the portfolio upside. So you might see if, let's say, hypothetically, if of all the stocks in the portfolio has an upside of 40%, the portfolio would also have an upside of 40%. It's basically the weights multiplied by the upside of individual stocks. So what we have done in this chart is, we have plotted how the actual NAV of Quantum Long-Term Equity Value Fund transpired since its inception, and how the predicted NAV based on the projected upside was kind of transparent if we have to plot it on a side-by-side basis. So what we are seeing here is, over long periods of time, and this is, remember, it's more than 15 years, 16 years of history. What we could see is, the predicted NAV has very closely tracked the actual NAV, barring periods of dislocation like the global financial crisis in 2008-9 or the COVID crisis in 2020. So barring that period, the predicted and the actual NAV is kind of moved in tandem, which kind of tells us that the process is fairly reliable and predictable from an investment perspective. So a couple of things I would like to highlight in this chart is, one, the red circles are two instances where you would see one is a global financial crisis and the other one is the COVID crisis. So whenever that the actual NAV significantly deviates from that predicted line, it is a screaming buy, which shows you have fairly high upside potential, probably 100. Probably it's as close as about 100% during that COVID crash. So that's when it shows a fairly screaming buy. But right now, if you look at the predicted and the actual NAV as of May end, it's fairly close. The actual NAV is just 5% lower than where it has to be in terms of the predicted line. But if the environment has some kind of is fairly supporting, if the economic cycle is in a fairly good shape, what we could see is we could see few more years of decent earnings growth, and that would ensure reasonable growth in the markets and even for the fund. So I have highlighted a very similar period in the green circle between 2010 to 15. At 2010, even post the market rally after the GFC crisis, the predicted and actual NAV has kind of coincided around 2010. But if you look at the next 4-5 years, the NAV has actually almost doubled. Where there was a broad-based economy, there was a reasonable interest rate environment which existed, which means there was a decent cost of capital. So in that kind of an environment, a fundamentals-based investing or a rational investing is likely to yield reasonable returns. And the current scenario, it looks quite similar to that. Next slide. So so I'll just quickly touch upon the portfolio positioning, and we have already spoken about most of the sectors where the fund is overweight. So there are two key sectors where the fund is overweight. One is the consumer discretionary, which is predominantly contributed by the two-wheeler space, where we feel there is significant potential in terms of volume improvement. Some of the stocks have a decent external demand from global markets, which are disrupted for various temporary issues. And plus, there are certain players within the mass segment where affordability is kind of has improved over the last few years. And therefore, we could see a reasonably good growth in that consumer discretionary space. The other sector where Chirag explained during his banking slide is the financials, where we have a significant overweight, out of which banks contribute close to 29% of that weight, and about 9 to 10% is contributed by NBFCs, insurance companies, and things. So where we feel, the banking cycle also, since the economy is in a good shape and it's in a natural upcycle, we should see reasonably good credit demand in the environment, in the economy. Plus, the banks have cleaned up their balance sheets to a large extent, and they have quite well provided adequate capital to fund this kind of a growth environment. So we could see good, reasonable returns even from the financial segment to a large extent. And IT, as and when the normalization happens, we would see at the current value, we would see the revival and the returns coming back. And the current environment, the valuations are fairly compelling compared to the broader markets. So now Chirag will, so coming to the portfolio characteristics of Quantum Long-Term Equity Value Fund. So whenever you select a value fund, it's very important to ensure that the selected fund depicts those value characteristics, which are typically better dividend yields compared to the indices, which is true in terms of the QLTVF portfolio. And the portfolio typically trades at a valuation which is at a discount to the index, but the EPS growth at a slightly lower EPS growth compared to the broader index. So if you adjust that, the PE ratio, the valuations for the earnings growth of the portfolio, it's fairly attractive compared to the index. With that, I'll take a pause here and hand it over to Chirag to take it forward.
Thanks, George. And here we talk about the Quantum India ESG Equity Fund, which is a very, very different and novel approach to look at equity investment. If you look at, we are witnessing very newer types of risk globally. So if you look at the global risk report by World Economic Forum, it highlights that, the major risks over the longer run are related to climate change. So there will be more natural disasters, there will be more extreme weather events, and that's because the global warming taking place. So overall, we will see the effects of that over as we become warmer and warmer as a globe, which will have its repercussion not only on climatic changes, natural disasters, loss of agriculture output. So there will be many things that we may witness, and the corporate sector may not be ready for such kind of risks. So overall, you need to ensure that, when these risks exist, the companies you're investing are looking at these kind of risks. At the same time, these risks also bring along with good opportunities, and whether the companies are capitalizing on those opportunities as well or not. So I think going forward, it's going to be incrementally becoming more and more important to look at these areas. And this is not us telling, but we can see these risks on heads of global investors. The World Economic Forum is suggesting every year that these are becoming more and more important risks. So if you look at on the right-hand side, long-term risk, you will not find any risk which is the economic or financial risk. It's more related to non-financial risk like environment, cybersecurity, cybercrime. Those kind of risks are becoming more and more important along with the societal risks. So even in India, if you see, of course, we have certain issues of our own like digital inequality, cost of living crisis, because We have seen a K-shaped recovery post-COVID, which is not where rural India is not improving as much as urban India. So those kind of risks remain, but natural disasters and extreme weather events are becoming more important. The cyclones, for example, we never used to see such cyclonic activity impact India so much, but now more than often we are seeing those kind of headlines that are impacting Indian economy or Indian markets as well. And the impact of climate change is going to be very, very real. Like this is a report from Swiss Re Institute, which is a reinsurer. So if you look at how much of the growth can decline once we cross certain climate thresholds. So if we are above that 2-degree scenario, that which is very, very likely now, given the changes that we are seeing in climate, and we continue to treat or lead the way we have been in terms of economic activity, it could lead to big shave-offs on GDP growth. So if you look at Asia, for example, the growth could be impacted by 14.9%. So close to 15% of your GDP growth could get impacted. So if you are, say, going to grow at 5%, 5% of 15% of 5% could be a meaningful growth shave-off. And if you're not looking at those instances, then those companies will face a tough time to cope up with that. And given that India is at the center of growth, India will be under pressure and more regulations will come. So if your companies are not ready for regulations, they will also again have a tough time looking at those kind of issues. So if you look at, it's not only these issues, the occurrence of these issues, as well as the losses associated with these issues have been increasing. So if you look at till 1998, from 1980 to 1998 or around 2000, there was only just one disaster that took place, which was greater than a $10 billion disaster. But if you look at now, post 2008 or 2010 onwards, we have seen many bigger disasters happening, greater than 10 billion, greater than 16 billion of losses, or even greater than $22 billion of losses that US had seen. This is just the US data, but if you look at the global world, it's incrementally looking at more and more losses on this front. If you look at US tops the list, but if you see India since 1998 or 2017 itself had a loss, given we didn't witness so many big disasters, still we had a $80 billion of loss that we had to occur. Even if you see the 10 most costliest disasters, 2 of them have been in India, and incrementally more as climatic changes take place, we may see more and more such bigger disasters. So it leads to physical risk and transition risk for your companies that we are investing with. And if you're not giving enough attention, we could face a very wrong investment at our hands because of the losses that the company may see because of climatic change. India remains very, very vulnerable. The direct loss estimate that India could have is 2% of India's GDP. So if our potential growth rate is 6.5%, the climatic disasters like earthquake, floods, droughts, cyclones could shave off 2% from 6.5%. So your growth may go down from 6.5% to 4%, 4.5% if you're not looking at these risks. And especially Northeast is at a much higher level of risk as compared to rest of India. But sooner or later, it will have its own impact towards many other states in Indian markets. Even if you look at the risk profile of ESG in India, India is more than neutral risk. So if you look at it's more towards more risk as compared to towards less risk. And you put it from a map of emerging market countries, India looks more riskier than many of these economies. So wherever a foreign investor is looking, and given that they pay more attention to ESG when it comes to their investing, they will look at India and they will say that, India looks more riskier. So our investment should cater to ESG risk or look at ESG risk in more detail and therefore invest in that manner. So more and more even investments would get channelized to companies that are looking at these ESG risks and adapting or mitigating those risks to a large extent. And therefore, it will make sense for investors to to play that beforehand and position themselves beforehand before such capital comes into Indian markets and chases these good ESG companies. So it's an opportunity for investors to kind of position themselves beforehand and also ensure that they have a good journey investing in companies that are prepared for such risk and will capitalize on those opportunities whenever they come, because other competitors will only try and get their act in order or will want to comply with regulations at that point in time, leaving more business to companies which are prepared beforehand. Also, if you look at India actions, like if you look at every nation has a pledge in terms of what kind of policies they are undertaking to mitigate climate change towards going on, say, renewable energy or trying to mitigate those risks. India overall, the kind of growth that we will see, the kind of consumption that we'll see, and therefore what kind of actions we should be taking, we are very, very insufficient in terms of our actions. Though we have pledges in terms of going to net zero in 2070 or have certain targets for 2030, they all are, or our actions are not backing those policies. So therefore, our actions are much lower than what it requires. And therefore, India as a country will be under tremendous pressure to ensure that we have more stringent policies in place. And when that comes, most companies will be unprepared. They will be wanting to meet regulations, and all those companies that are part of ESG portfolio are prepared for that next leg of curve unfolding, will try and capitalize on the opportunities at that time when others are scrambling, which will lead to better outcome for those companies. So overall, don't stay in denial. Don't just look at economic growth and profits because this is happening for real. The climate change is happening for real, and it will have a more far-reaching impact on your investments because we are all in the same boat. The society and the environment, as well as profits, are in the same boat. If we don't take care of society and environment, the profits will drown along with it. So it's time that we ask, not only saying that how much return, but how much sustainable return, because that will stay and may further increase given that there will be more emphasis from a regulation standpoint, from investor standpoint on these issues, and therefore the ones that are prepared will have a good time later on. So overall, ESG investing looks at these three things. One is planet, people, and profit. Anything that has a material impact on the financial performance of any company, that needs to be taken into account, because that could be a risk, and how company tackles those risks could turn out to be an opportunity for those companies. So I think, I hope everyone believes here that climate change is happening for real. It will have its impact going down the line on the economy, on the companies. Say if there are companies which are closer to coastal areas, the sea level rising could cause repercussion to their operations and stoppage to their operations, and therefore have a hard time if they're not mitigating or diversifying the risk. So climate change, pollution, water is another critical element of our evaluation. Waste is another critical element of our evaluation. So companies that are prepared from an environmental standpoint, looking at climate change, pollution level, water, waste, are kind of good companies. From a people or social perspective, companies that have good diversity. Again, cyber risk is becoming very, very real. Companies are having to pay a very high ransom amount if they are under an attack. And therefore, if companies are not secure enough from that threat, then they will have a very tough time. So all those companies who are taking that into account and taking that very seriously will kind of emerge as winners going forward. Also, governance has always been important. If how the company treats minority shareholders, what is the business ethics of the company, is the board really independent or not, or do you have friends and family sitting on the board as independent? Then minority stakeholder rights are always under pressure or under question. So looking at governance aspect of companies has always been important. There have been so many instances in Indian corporate area that because of poor governance, investors lost a lot of money. So when it comes to a company that is looking at all these three aspects as really a quality company, ESG evaluation is a mark of evaluating quality of any company, and quality as an investment generally does well over the long run. So if you look at ESG is one of the fastest growing investments globally. There are more than 3,800 investor signatories who have signed up for PRI. They represent around 121 trillion, and incrementally they are incorporating ESG in most of their investments. So if you look at the assets under management have been continuously climbing, the number of signatories have been climbing, and most of the big investors have said that incrementally they will incorporate ESG. And it's not charity. In ESG is also about investing in quality companies, companies that are prepared for tomorrow. And we have seen ESG do better over the long run. So if you look at two indexes of India by MSCI, the MSCI India Index and MSCI India ESG Index. If you look at MSCI India ESG has outperformed significantly the MSCI India Index, which is a normal market cap weighted index, and telling you that, you know, ESG outperforms over the long run. And also, if you see times when markets have fallen, ESG has generally fallen lower than the market declines. For example, in 2011, the MSCI India fell by 37%. The ESG index fell by only 31%. So time and again, we have seen that it generally falls lesser, like also in 2018, when MSCI India fell by 7%, the ESG index fell by only close to 3%. So generally, we have seen even during the COVID period, we saw ESG indexes had lower downside as compared to normal market cap weighted indexes. So ESG also does well when it comes to performance. So even if you look at our experience in the Quantum India ESG Equity Fund, which has a very robust process, a proprietary process, a proprietary team, a big team that looks at ESG aspects in detail, has led to our outperformance over close to a 4-year period. So if you look at our since inception return have been about 16% CAGR, whereas Nifty 100 ESG index is just 14.7, and BSE 30 index was 14.5%. So we have done better over the long run. There was some impact to ESG kind of companies in 2022, where we saw value stocks doing well and ESG not doing well. Again, this year we have seen a bounce back in performance. So we think that ESG does well, and it complements the value investing very, very well. So if you see, both have complementary performance. So if you are allocated to ESG and value, you have a very good complementary style of investing that balances out your risk and return in a bigger way. So with that, I think these are the two effective strategies that you could add to your equity allocation, so that, you know, you have very differentiated styles of investing, the value investing and the ESG investing, and that completes your overall opportunity set of equity investing. So with that, I will urge you to look at both these funds and add it to your portfolio to make it a complete allocation to equities. With that, I will hand it over now back to Neeraj, and we'll be happy to answer any questions you may have.
Yeah. Thank you, Chirag and George, for the insightful presentation. I'll request all our listeners to post the questions in the chat box. Chirag, I'll just ask the first question which I have received. Are the present market indices justify the fundamentals, or they are at the peak because of funds inflow from FIIs?
See, FII investors, first let's address that and then come to whether the market levels are justified or not. FIIs were generally sellers in markets for a very long time. It's just a couple of months that they have shifted sides from being an outflow to an inflow. So overall, FII investors are just trying to come back into our markets. So I don't think that they have really led to a very high market level. Rather, domestic investors have been big buyers in our markets all through last year as well as this year. So there have been investment flows coming into market, but from domestic investors, not the foreign investors. Foreign investors, we think, could increase their inflows going forward from here on, given India looks a very steady market from an earnings standpoint. Secondly, I think we are not trading at overtly high level, telling us that we are in euphoria territory. We are at our 10-year median multiples. It's slightly higher than very long-term multiples though. But it is aided by earnings growth. So overall, what we were seeing from, if you heard us from 2015 till 2020, we were more bearish on the market because we were not seeing earnings growth. When we spoke to companies, they were saying that, there is no real ground level activity that we are seeing. And therefore, that made us what's moving the market. It was more liquidity and more PE expansion that was leading to higher market levels. But this time around, PE levels have not gone through the roof like what we saw earlier. Earnings growth is very, very supportive. So in the market fundamental standpoint, we are seeing earnings growth coming through, which is a very robust sign. And we are hopeful on growth going forward, and therefore earnings growth further improving from here on. Like George pointed in his slide, what we saw in markets from 2015 till 2020 kind of period, 2011 till 2015 kind of period. We are in that kind of zone where we are seeing earnings growth come in for the companies, and markets kind of continue to move along because it was supported by earnings growth. So if you look at this chart as well, from 2015 till 2020, there was no earnings growth. Each year started with a higher level and then declined in terms of what actual earnings were. So, but it is very different from if you move on to the right-hand side of the chart, FY 22, 23, 24, 25, there is earnings growth happening, and it's expected to move on further. It's expected to grow from here on as well. Which we don't think is, euphoric. It's underpinned by strong recovery in the economy and therefore a strong earnings growth. So overall, we think that markets are well placed currently. If the earnings growth turns out to be true as we expect, then markets may move further from here on.
Thanks, Chirag. Chirag, there's a question on ESG funds. There was a recent article about ESG fund not adhering to the stated objective. Is Quantum ESG fund true to the label?
Absolutely. And we could prove that the way investors want it. It's absolutely true to label. It's not, we jumped onto the ESG bandwagon when it was in fancy. We started our journey in 2014-15. We went through a learning curve. We established a proprietary framework. We are not relying on third-party scores. We have a team in-house that looks at separately on ESG. We have a 9-member team that looks at ESG aspects at Quantum. We thoroughly analyze each and every aspect on ESG. We kind of try to not take every disclosure on face value. We try to verify a lot of information that corporates put out in the sustainability reports, on the DRSR reports. We have been part of many policy advocacy groups in India, like the government task force that was set up to increase sustainable finance in India. We were part of the CDP India working group. We are part of the India CIF. So we have been torch bearers of ESG in India in some sense. We kind of take it very, very seriously. Like governance has always been an aspect of our evaluation. right since our investment as a group since 1996. And also in the quantum mutual fund space, right since our day one, we had strong emphasis on governance. Now we have expanded the framework to include environment and social aspects as well. So I think we have a very robust methodology. We have a very robust team. We verify a lot of credentials. We think ESG is not desk research. We kind of go out and verify a lot of things by doing a 360-degree check on companies, and thereafter invest in companies and still stay on top of what's happening in those companies. So, so if you look at the same article that we pointed on most parameters, Quantum India ESG Equity Fund was scoring much better. So if you look at the turnover ratio, we were the lowest, which tells you that our investments are more longer term and therefore not incessant churning, which is a hallmark of ESG investing. Again, if you look at the Morningstar rating or the CRISIL rating, we were the highest amongst most funds, which tells you that again we are very even if you assess from a third-party lens, we are doing much better on ESG. So overall, and if you look at our performance, it tells you that our performance is also much better while sticking to the ESG principles, which tells you that our process is kind of delivering better returns as well. So I think we are very true to label. And if you look at our methodology, ESG determines the weight of companies, and other financial checks, other guardrails that we have built on investments are additional to the ESG weighing mechanism that we have. So what others do is ESG becomes just a filter and other things decide the weight. For us, ESG is crucial. We think it will deliver well over the long run. And therefore, ESG decides the weight of companies, and we have certain checks and balances in place like financial filters, sector guardrails, stock guardrails that helps us mitigate the risk in a way. So overall, we think our approach is very, very true to label, and the things that we do are representing that we are very committed to ESG as an investor.
Thank you, Chirag. George, next question to you. Corporate debt equity ratio is going down. Brand credit growth is increasing. Where is the money going?
So if you look at the bank credit growth, a lot of that was fueled by the retail credit demand and some bit of working capital requirements in the last couple of years. But going forward, what we are seeing is, let's say one of those slides where Chirag showed where the corporate debt equity has come down to a reasonable level. Plus, corporates are earning decent returns on their existing assets, which means your return on assets or return on equity is fairly healthy. Plus, you have a capacity to borrow. In that kind of an environment, we could see that corporate credit demand coming up in the next few years. Of course, we would see some moderation in that working capital-led demand where you saw all those commodity prices and input prices going up, and therefore that requires corporates to have a higher working capital. And that was one set of demand which kind of was there in the last couple of years. But now with all the capacity utilization reaching a reasonably decent level, there would be a requirement in terms of building factories, building manufacturing capacity, and that would help in terms of bringing up some bit of the corporate demand. And the other portion, which is the retail credit demand, that would continue to do reasonably well because the employment scenario is still reasonably well. Of course, we are hearing some bit of sporadic news in terms of troubles in the startup environment or companies which are reliant on private equity money, but those are very far and few, and it's not very significant in the overall scheme of things. So credit demand, these would be the few drivers which would take the credit demand forward.
Thanks, George. Just next question. Won't the removal of FAME subsidy hit the EV market badly? Also, companies like TVS Motors commanding a sizable size of EV, are we seeing a decline in the performance in the short term or even in long term?
Yeah, so if you look at the recent news on EV subsidy, So the earlier the subsidy could be as high as 40% of your vehicle cost. And that has come down to just, that is capped, the cap is reduced to just about 15% of the ex-factory price of those EV two-wheelers. So what would typically happen is, for OEMs who have placed their electric vehicles at a substantially lower price and used to have a higher share of their price as EV subsidy, they would be impacted to a larger extent and they would be forced to take price hikes, which we have seen by 1st of June, where most of the OEMs have taken price hikes to offset that the impact of lower subsidy. So that could prevent or restrict the share of EV adoption to some extent, at least in the next few years. So one of the essential things in terms of having a viable electric two-wheeler roadmap is let's say less costlier batteries, because battery form almost 50% cost of an electric two-wheeler. And that is more reliant. One is a technology part. The second one is, there is a lot of lithium ion requirement, the metal, the commodity requirement, where, you may not be able to scale it up very rapidly at a reasonable cost. So our sense is, at least in the medium term, we would see those conventional vehicles dominating, and that share is unlikely to change in a material way. Of course, the recent news is beneficial for the traditional OEMs who has a larger share of those ICE vehicles or the internal combustion engines.
Thanks, George. Chirag, next question to you. ESG fund or value fund? Wouldn't ESG guidelines be incorporated in selecting stocks for the value fund?
So yeah, so both have very different approaches, right? Both have a strong emphasis on governance, on liquidity. Value fund looks at governance as a bigger aspect. They do look at E&S risk as well, but they would want to engage with companies and give them time to improve over a period of time. So that's the approach the value fund has. Whereas ESG has stricter thresholds in terms of how the company is performing today and how it's likely to be in the future. So we do engage with company as well, but we need a minimum guaranteed threshold for the company to have achieved for us to believe that they are going on the right path. So when it comes to, say, for example, environment or climate change, companies should showcase an intent. Second is, it should showcase that they have made some progress so that there is some validation of their intent, and what kind of targets and policies that they have to reach a desired level going in the future. So that are the three things that we see in the ESG fund. But we do a very detailed analysis, whereas the criteria is very, very different in terms of stock selection. And that is why I say both are very, very complementary styles. For value fund, valuation is the stricter criteria, most stringent. Governance comes second. And E&S is something where they engage and try to make better over a period of time. Where in ESG, the current ESG score of the company is very, very essential. They should have a meaningful ESG score, a positive ESG score for it to be eligible. And then financial filters, etc., become the secondary, or financial stability, soundness becomes a secondary criteria for selection. So here you will get a more value bent, and there you will get a more growth bent, and which looks at the ESG risks. So from a risk mitigation perspective, you are covered to some extent from the severe blow-ups that you could see going forward from a governance standpoint, from environment and social regulations perspective. But at the same time, it's value agnostic, and therefore you get, financially sound companies, but very good at ESG. At the same time, you will find a flavor of growth and quality within those investments. So both are very, very different. Both incorporate ESG in a very, very different manner. And therefore, I would say, given that the emphasis on quality there, which is ESG, the parameter of quality, and here valuations is the criteria that goes or is emphasized more. So one, you get a value kind of approach. Once you get a growth and quality kind of approach. So both complement very, very differently, and therefore could be added to your portfolio and have very different approaches into your investments. but both look at risk in a very different manner, and both look at opportunities in a very different manner. So it does incorporate, but it incorporates very, very differently.
Thanks, Chirag. There is another question on ESG. I think so most of the part you have answered, but I'll just repeat the question. Is there any template of attaching higher valuation for better ESG companies? Why is that value stock outperformed ESG stocks? Are value stocks less likely to be ESG compliant?
So, so if you look at value stocks, will have its own own theme, right? In terms of you have a margin of safety, you have a cushion built in terms of valuations, and if catalysts play out the way you envisage, then the valuation will achieve, or price will increase to that extent, and you will book profits. Whereas in ESG, the idea is to back good corporate citizens. So we have seen, if you look at what people generally talk about, long-term compounders, etc. What are the traits of those companies? They have very good governance, very good management, very good risk mitigation practices, very good vision in terms of looking at the opportunities, and all these mark quality, in some sense define the quality of those companies. ESG exactly measures that quality of those companies, and therefore if you want to invest into a quality business, ESG is a much better mechanism to define quality today. And therefore if you invest into those kind of businesses, you should make money over the long run. So as I said, both encompass ESG traits in very different manner. Governance for both is non-negotiable, but ENS risk in a very different manner in the value fund, whereas in the ESG fund, and both approaches are very, very different. One is looking at measuring quality, one is looking at how do I achieve the value mispricing that exists in the market today and take advantage of that. Whereas here you are trying to find out those quality businesses that can compound your wealth over a long run. So both are very, very different approaches. At some point in time, value investor may exit those businesses because they may not see or they are a threshold of value would have been achieved. But we have seen that, there are compounding stories which kind of unravel or unfold over a period of time, which advantage the ESG fund could take as it kind of stays invested in those kind of companies. So there are certain sectors, for example, great companies which may not fit the definition of value today, but still are generating decent returns for investors. For example, staples, consumer staples. So value fund may find it expensive, but still if you see the contribution from staples, for example, this year in returns has been pretty good in the ESG fund. So both are very, very complementary styles. And if you are invested in both, you get best of both worlds, where you can play the valuation catch-up game, as well as, quality investing as well into potential companies that could look at compounding your wealth over a long run.
Thanks, Chirag. Chirag, there's a question on the CAGR. What kind of CAGR we are expecting from both our funds in next 3 to 5 years?
So, I mean, so the template is good. I mean, we have it for India, right? We have showcased that before. So India real GDP growth rate will be around 6.5%. Inflation will be around 5.5%. So nominally, India should grow at about 12.5% growth. So if India is growing at say 12%, that is average of all companies in India, right? Because that's the India growth rate. So good companies is in index, for example, which are formalized and having a good market share, etc., should increase at slightly higher level than the average companies. And if you are a good stock picker, then you will invest in good, better companies and take advantage of the mispricing in the market. Then you will achieve, you should make more returns than the index companies. So if index is growing, say 1.5%, 2% more than the average company, so that should be around 13.5%. And if you are a good stock picker, you could add another 1.5% to further to it. So it could be anywhere between 14 and 15% that India equity markets should deliver over the long run. Our styles have done better than the indexes over the long run, and we think that we could try and endeavor to deliver similar kind of performance going ahead as well, or even better performance through our stock picking ability, and therefore should do better than the indexes over the long run. So we think that India has a potential to deliver 14-15% return over the long run, and we should be able to deliver handsomely on that.
Thanks, Shira. John, next question to you. It's on IT sector. If external environments deteriorates, the sector likely to fare poorer. How can there be any better returns there?
Yeah, so if you have seen my the IT sector slide, where you could see 2008, where you see the red mark is exactly the environment where you're kind of alluding, where the external environment deteriorates significantly. And in that kind of a scenario, what would typically happen is corporates, the enterprises in those foreign geographies, they would be hard pressed to control their IT spends or the overall budget for technology. And the obvious solution to that would be to increase outsourcing or shift your development base to a country where it could be done at a much cheaper rate. So even now, with the prevailing rates, the Indian IT engineer is available at almost about a 1/3 cost of his US counterpart. So in that kind of a proposition, in case of Indian IT service company, who enable them in terms of upkeeping those in enterprise systems or the digital systems, they would see a very high spot in demand. And we could see something similar to the demand growth which we saw in 2009. Of course, the scale could be slightly lower, but the growth could be reasonably much better than what we have seen in the last few years. So that is one scenario where the external environment deteriorates significantly. And if you look at the current scenario, the reason why we are seeing some bit of demand moderation is, so if you look at the order books of all these IT companies, they are fairly healthy. So the order books, which indicates the kind of potential projects which they could deliver over the next few years, that has not deteriorated despite all these negative news. But what typically happens is, in an uncertain environment, from a decision maker sitting in US or Europe, he would be, he's not sure, what would be, how the environment would face in the next few quarters or few years. So in that kind of an environment, they would defer those projects which they have identified, and they will not start those discretionary projects which would enable them to achieve better business results. So if the environment normalizes, you would see that kind of picking up, and that would give some filler to growth. But if the environment deteriorates significantly, it would be fairly beneficial for the larger IT service companies. But of course, if there are, let's say, product companies or companies which cater to ER&D demand, those are all very discretionary kind of projects, and that those kind of pick up when everything is robust. So those segments would see pressure, but a traditional IT service company would benefit if the external environment deteriorates, or the environment kind of if it normalizes, you would see the current healthy order books translating into better projects.
Thanks, George. George, next question is, how would value style perform in the current market environment? Yeah, so if you look at our prior to 2020 period, when prior to COVID, or even a few quarters post-COVID, when the interest rate is abysmally low, or let's say is kept low by central bank liquidity and things like that, or their urge to stimulate growth in a bad economic environment, in that kind of a scenario, you would see growth stocks kind of doing well, where the price to earnings multiple is not
In terms of growth stocks, the investors are ready to pay much higher the PE multiples, even for a marginally better growth. So in the current environment, we do not see the interest rates going back to those low levels which we saw prior to 2020 or around that time, at least in the medium term. And that is one factor which would support the value stay. The second important factor is the availability of a large number of companies where there is reasonable fundamentals. And I say fundamentals, it means if there is a reasonable earnings trajectory or earnings growth. So even if the stock prices move up, it is justified by those earnings growth, and that's a very healthy environment. So in the current setting, so unlike the period which we saw between FY15 to FY21, where you would see those the consensus earnings estimates only in a downward trajectory, and that is not the scenario, at least in the next 2-3 years, where we are seeing good earnings growth, and therefore there would be a lot more companies where the valuations are justified by that earnings growth. So one, the PE multiple, there is a cost of capital, therefore the stocks, the valuations would trade in a reasonable range, unlike those ultra low interest rate period. And then there is a decent set of companies where you are seeing the robust earnings growth, where valuations can be justified by that earnings growth. So in this kind of an environment, value should do reasonably well. And we are seeing that setting at least for the next few years.
Thanks, George. Chirag, next question to you. What is Quantum MF's view on quant investing ESP in the world of generative AI, ML, big data? Can machines deliver better alpha?
So machines can crunch numbers, but they can't, really get to know or get into the governance aspects so very well. So you need a human judgment. You need, to meet the management, to understand. You need to do some 360 checks, etc., to kind of verify certain things, which is very difficult for, say, a machine to go about it. So maybe certain type of strategies like momentum, etc., can be achieved through machines more efficiently. But if you look at any investing, and I think investing is also an art as compared to just being a science. It requires human judgment to a large extent, and which could make a very big difference when it comes to investment outcomes. So overall, you could make it better, but I think you cannot shield away from using human judgment to either reduce risk or generate a better return. So I think, for example, the various aspects of governance can only be, ensured when you meet the management, do some work by talking to stakeholders, etc. Plus, if you want to, get the other side of the story when it comes to talking to the management, knowing their plans, knowing how they will react to certain situations, how they will kind of, overcome certain risk areas. So those kind of things require human interaction. And I think that is where I think machines may not live up to the expectations so much. So of course, we can improve our investing ability through use of such machines, but I think it cannot replace the human touch needed to efficiently invest in markets.
Thanks, Chirag. Next question is, ESG theme needs investments, training, knowledge, and only large companies would be able to do so. Isn't it that Nifty 50 large companies would be natural companies of ESG theme?
No, that's not true, actually. So if you look at even smaller companies, they have been pretty forward when it comes to the thinking on ESG. They have been shaping up well. So if you look at the Quantum India ESG equity fund portfolio, so about close to about say 30% or so is in mid and small cap companies. So overall, it's very, very different portfolio as you there are common names, but still at large, it is a very, very different portfolio as compared to Nifty 50. And regulations are going to shape that very, very differently. So I agree that larger companies have more resources at hand to kind of train themselves and fulfill their aspirations on ESG and make them better on risk management on ESG. But given regulations are shaping in such a way that if you look at SEBI mandate, they've mandated top 1,000 companies from this year to give out a lot more granular data on ESG. And once you have to give out that data and you approve on that data, you will be compelled to, work on it and improve it over a period of time. So it's not that it will stay focused on only larger companies. Smaller companies also, because top 1,000 will cover a gamut of all companies. Given Nifty 50 is just 50 stocks, it's 950 stocks over and above that, which will have to give a lot more data. And it was up on as ESG investors to look at those data points, parse those data points, and evaluate them and verify them to ensure we kind of differentiate between companies and investing in better companies. So, so far, it's been the case that larger companies were ahead of the curve. Now, given that companies will start with measurement, given they have to give data out, and when you measure, you tend to improve. So I think smaller mid companies will catch up a lot faster to larger companies, and it's going to be all cap investing when it comes to ESG, because companies will have to give a lot more data and will have to engage with investors as they give more data out. So I don't think it's going to remain restricted there. So far, it's been skewed slightly towards that point, but now it's going to become more wider as compared to what it has been over the last few years.
Thanks, Chirag. George, next question to you. What role does diversification play in equity investing, particularly when considering the fast-paced expansion of the infrastructure sector during a market rally?
Yeah, so the infrastructure space, so it's a great macro theme in terms of, even if you think about India, it's very obvious that, the infra needs to improve by leaps and bounds, and there is significant potential in terms of that improvement. But when you look at micro themes where there are very less companies which has good governance practices and are available at a reasonable valuation. So there could be there are few goods companies where it could potentially play that infra theme, but even they're pretty expensive at this point in time. So you can, so what QLTBF does is you place those infra theme through the financials, where you would obviously see a reasonable credit demand as the infra develops, and that gets spilled over to other sector, or even the consumption would boost in the long term as infrastructure improves. So it would be the infra theme would be played by a lot of those allied sectors rather than playing those pure infra companies, primarily because the governance is a concern for most of that bucket. Plus, the valuations are not where we would like them to be.
Also, if I growth in infra does not always translate to returns for investors, because if you see many investments are very lumpy for companies. They tend to happen, and the payback periods are even longer for these kind of companies. So overall, it may be a growth sector. There would be investments moving in that way. But it's not always that investors will end up money investing in those kind of companies, because cash flows for those companies can be very, very erratic, happening over a period of time. And the investments are upfront for those companies. So it could be, growth does not always translate to returns for investors.
Thanks, George and Chirag. Chirag, can you refer to the EPS slide? Like, is estimated EPS for financial year 25 and financial year 24 Can you just highlight on from this particular?
Yeah, so if you see the consensus earnings growth, like FY23 is done, so we will end up very close to that number. 24 and 25 are gonna be growth years. So 24, I think the growth rate assumed by markets is close to 15% earnings growth in 24, and even 25 we should be staring at a double-digit growth rate. So if you see the orange line, the FY25 line, the way where it started and where it is currently placed, you've seen upgrades, which means that investors are expecting that earnings to be better over a period of time. As more data comes in, they are getting more confident about that number when it comes to FY25 earnings growth. So we think that there is momentum in the economy, and if the economic momentum continues further, which is likely, the earnings growth should be where the consensus earnings is. And probably last year we were saying that consensus earnings could be shy because all these years they got it wrong from FY15 till FY21. And now when it comes to real economic growth, which is leading to a higher earnings growth for companies, they may be shy of calling it out. And that is where we see that upgrade cycle starting in 2 years out as compared to next year. So I think we should see favorable earnings for companies going forward. We are expecting at least double-digit growth coming for markets overall, broad markets over next couple of years.
Yeah. So share the question.
I'll just add to that. I think the investor was looking for the EPS growth.
EPS, QLTF.
QLTVF. So if you look at the weighted average, weighted EPS growth on a 2-year basis for QLTVF portfolio, it is at 14.9% versus about 17.3% for the Sensex. So that is at about a 14% lower than Sensex. But when you look at the 2-year forward price to earnings ratio, so that is available at 12.5 times compared to 17.4x for Sensex. So valuations are cheaper by about 28%, whereas the earnings is lower by only 14%, which means PE adjusted for earnings growth is quite attractive.
So we were mentioning about the contrasting approaches that long-term equity fund has versus the ESG fund. So earnings growth for long-term equity fund is 14.9, whereas the PE is lower than the market, whereas PE for the ESG portfolio is slightly higher, but supported by even better earnings growth profile. 2-year out growth for the ESG fund is upwards of 19%. Which tells you that it's a quality growth portfolio and supported by higher earnings growth profile. While it may look expensive than the market, but it has supported by higher earnings growth. So at one point you have comfort in valuation today, other side you have comfort in higher earnings growth. So you can complementarily play both together by investing in each of them.
And that valuation is 2-year forward. We'll correct that. That's a mistake. It's not March 2023 estimate. It is March 2025 estimate.
Thanks, George and Chirag. Chirag, next question is what are some common strategy used during a market rally to mitigate risk?
So Neeraj, can you repeat that, please?
Yeah, sure. What are some common strategies used during a market rally to mitigate the risk?
So whenever there is a market rally, right, there are 2 ways you could that could help you during such kind of rallies, because you want to capitalize on the earnings growth story, as well as you want to be slightly defensive in whenever a fall comes, you should be kind of safeguarded. So 2 things that can help you safeguard. One is if you have a valuation comfort, you have a margin of safety, which the value fund offers you. Right? If you see value fund is cheaper, much cheaper than the market, which means that there is a cushion in case markets fall, probably something that's cheaper will fall lesser. And therefore that could give you that cushion whenever the market falls. Plus, at the same time, there is a earnings growth story which will help you ride the market rally if that were to occur. Secondly, if you are invested in quality companies, that is another way to play the market. You kind of get the market rally, you can catch the market rally. At the same time, whenever there is a fall in markets, there is a flight to quality, and quality usually falls lesser in those kind of markets. So overall, it may be expensive, but quality is something that is sought after. Like, for example, when the fall comes, IT, consumer staples, etc., places where markets kind of shield themselves, and therefore they fall lesser during such kind of events. So I think, again, this brings into the two contrasting investing opportunities that we are talking about today. The long-term equity value fund, which is a value style, which could be at your advantage if there is a market rally, as well as if there is a fall, it could help you cushion those falls in those times. Another is ESG, which is kind of helping you to invest in quality companies, which kind of helps you play the market rallies well. At the same time, it kind of ensures that if there is a certain event in market, quality will help you kind of protect the value to some extent, as quality becomes more desirable in times of market shocks. So both contrasting, but both could help you play the market going forward as well.
We can take one or two more questions. I'll request listeners to pose their questions, if any. Chirag, there's one question. How can I balance the potential risk and rewards of equity investing during a market rally as I approach retirement age? Chirag.
Yeah, so if you are approaching retirement, I think one needs to lower their equity exposure to an extent, not so much that you don't even participate in equity. So it has to be balanced out very well across. So one is you could have a measured approach to equities. There are different ways you could do it. You could kind of build your own custom portfolio, like you can go to our website, and if you want a higher emergence corpus or a lower equity allocation, you could play around using that calculator. Second is you could be invested in a multi-asset fund, which kind of helps you gain appropriate opportunity in markets as they come, but they are mindful of the risk of equity markets, and as valuations go high, they kind of lower your equity exposure. So either you could craft your own portfolio if you understand that better, or you could go to a ready-made solution like a multi-asset fund, where you could, that helps you invest through a measured approach to equities, and take a measured call on equities, so that you kind of participate in meaningful rallies in markets, but at the same time, whenever the risk increases, they reduce the risk for you. So for example, the quantum multi-asset fund of funds does exactly what I said. They kind of participate in equity markets when there is an opportunity, but otherwise they will try to protect the risk as equity markets keep inching higher, and if there is a valuation wise they become expensive, it will kind of lower the equity exposure that they have. So you could either do it yourself by going to our website and looking at, or you could take help of your financial advisor, or you could go into a ready-made solution like the quantum multi-asset fund.
Thanks, Siraj. George, a last question for you. As a 45-year-old investor, how can I strategically position myself as an equity investor to benefit from government capex initiatives aimed at stimulating private investment during a market rally?
Yeah, it's very similar to my the previous answer. So when you look at companies which are solely or which are only reliant on those government capex, one of the issues of course, the opportunity size is a lot larger, and therefore you might see that reflect in healthy order books for a few companies. But that order books translating to let's say revenue, that could not be a very easy process, and it would be a long-run process. That is one point. The second aspect is so a lot of those companies which are reliant only on this government capex would see fairly high working capital requirements, and there could be problems with receivables and things. And obviously, these are businesses which generally trade on very low margins. So even if their contracts were to take some hit, or if something does not go as per their plan, we might see a higher impact on those companies, because those margins are not sufficient to absorb those shocks. So if you want to build exposure to equity investing, and if the government improves its capex and if private capex is followed, that would have a ripple effect on many other sectors. It will eventually boost consumption in the economy. That's one thing. Plus, even the company becomes more competitive for the external world in terms of better manufacturing facilities. That would ensure there is reasonable credit demand in the economy. So it will not be just that capex related themes which would benefit. There would be a holistic development in that case. So if you want to benefit from that, from your long-term horizon, it's better to have a diversified equity portfolio rather than focusing just on a single theme. And that would ensure a reasonable earnings growth and translating to decent returns over the long term. And equities, by and large, would be the best asset class in terms of generating returns for long-term horizon. So therefore, I would advise you to have a diversified portfolio for your long-term equity investing.
Thank you, George. With this, we will end our Q&A session. Chirag and George, any closing comments from your side?
Yeah, so I think what George just said is very, very critical, right? You need to be exposed to to equities, which is very, very needed from an Indian investor standpoint, because if you were to meaningfully beat inflation, if you were to meaningfully lead to wealth creation and a better standard of living, then I think you need to have a higher exposure to equities, provided you have the ability to take that risk. Because whenever you invest into equities, you should be prepared for a 30, 40, 50% fall in equity markets. At the same time, if you are a patient investor, you could reap rewards which are double-digit gains over the long run by investing into equities. So have a higher allocation to equities, asset allocate. You need to have an emergency corpus so that you don't sell your equity investments at the wrong time. You need to have diversifiers like gold for an investor in India, where the currency kind of keeps depreciating by 2-3% every year. You need to have exposure to diversifiers like gold, for example. So asset allocate, don't just go because the equity returns are better over the long run. You never know when you need money. And, at that point in time, if equity markets are down, you could be staring at a loss. So asset allocate, rebalance your portfolio, have a larger chunk to equities with right diversifiers in place. That should yield you a good investment journey over the long run. So with that, I think you could use the calculator on a website. It's very, very easy, very, very beneficial. We have been using it ourselves, and I think it will help you to be disciplined, to better allocate, and wish you happy investing with that.
Thank you, Chirag, for your valuable comments. To know more about our 12-20-80 asset allocation solution, we'll request all our listeners to visit our website, www.quantumemc.com. Also, further, for any questions to be answered, you can write to us at customercare@quantumemc.com, and we will be happy to answer the same. Once again, thank you everyone for giving your valuable time. Stay safe and happy investing to you all.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.